Well, I keep saying this, what goes up must come down eventually, but right now the Dow is not doing that. We're on track for yet another record, so let's bring in Scott Black. He is telling you what to do when it comes to picking stocks. Barron's featured him on the cover recently. He's one of the paper's investing gurus, and thank you for sharing your expertise with our viewers here, Scott. I've got no problem with record after record. You know, we like our bulls just as much as we like our bears, but why are we seeing multiple all-time highs day after day? Does that worry you, or are you fine with it?
Well, I don't try to pick the market, but I think the reason is that nominal interest rates are so low, even in the United States, and there's no alternatives for yield, so people figure even at 19 times earnings, it's a bargain vis-a-vis anything you get in the bond market. But I think the real issue is it's very expensive. Small cap stocks are 24 times. But the big problem is there's no earnings momentum. We were down 7% year over year in the S&P earnings in the first quarter. We're going to be down another 5%. So it's dangerous to have a rising market with down earnings.
Okay, so right now, though, we do have yet another record for the Dow Jones Industrials. As you look ahead, you know, some people say buy value names. Others say go for the gutsy ones, the growth stocks. Yesterday, we had Michael Binger of Gradient saying transition to growth stocks. What do you say about that, and how do you view what you're putting in your portfolio?
Well, our idea is what Warren always says, to try to buy growth companies at value prices, and that's what we do. Companies that have up earnings, but you buy them at low multiples. They're getting increasingly difficult to find, but I have a couple for you today.
Yeah, we've got them up on the screen, Celestica and Icon. And as we keep it macro, because people can do their own little research on this, what do you expect for the next couple of weeks? Again, it's earnings season, but this is a headline-driven market sometimes, with the Bank of England weighing in, and who knows what the Fed will do.
I don't think the Fed's going to raise rates. We got a nominal GDP in the ones. It might be 2.5%. There's no way they're going to raise rates, so you can forget about that. I think the market can continue on, barring some major crisis, whether, even terrorism was discounted today, which would happen in Nice. I think there's a lot of money flows into equities at this point. But as I say, stick with companies that you want to own. It's the old musical chairs. When the music's turned off, you want to make sure that you still got a good business that you own.
I hear you.